In this segment, we will look at the use of break-even analysis. When a manager is making decisions within a company, it often helps to take all of the company's costs and reorganize them by behavior, reorganize all costs and recategorize them as either variable or fixed. Once we have all the costs identified as either variable or fixed, we can then apply break-even analysis. The break-even point is expressed as either the number of units needed to break even or the dollar amount of sales needed to break even. But this break-even point is the sales level at which a company neither earns a profit nor incurs a loss. It's the point where the company breaks even. To compute the break-even point, we're going to reorganize all of our revenues, expenses into this new contribution margin formatted income statement. Recall that an income statement reports revenues earned and expenses incurred. Here we're seeing this company sold 2,000 units, earning revenues of $200,000 at a selling price of $100 per unit. We have taken all of the costs incurred and broken them into variable costs and fixed costs. If we take the revenues and first subtract out the variable cost incurred during the year, we are left with what's called the contribution margin. The contribution margin is the amount by which revenues exceed the variable cost of producing the revenue. In other words, once the company's variable costs are covered by their revenues, they have $60,000 remaining to help them cover the fixed costs they incurred during the period. So if we take the contribution margin and then subtract out all the fixed costs, we are left with the net income of $36,000. These are not new costs. These are all costs that a company has worked with in the past, but in the past we identified them as period costs or product costs, and that's how they're reported externally. But for internal informational needs, we have reorganized those costs into variable and fixed components. So we can ask ourselves, how much contribution margin must this company have to cover its fixed costs? Well, we would need a contribution margin of $24,000 in order to cover their costs and just break even. Then the question becomes, how many units must this company sell to cover its fixed costs and break even? Well, if we know that we need $24,000 in fixed costs covered by the contribution margin to break even, we know that if we take the $24,000 needed and divide by the contribution margin of $30, we would need 800 units sold to break even. So we can evaluate the break-even point using the contribution margin formatted income statement, but we have shortcuts. Our shortcuts are to use one of our formulas. In order to calculate the break-even point in units, all we really need to do is take a company's total fixed cost and divide by the contribution margin per unit. Recall that the contribution margin per unit is the unit sales price less the unit variable cost, which was $30 in the previous example. If management wants to know what the break-even point is in dollars, instead of in units, we can use that formula that we used before and just slightly alter it so that we take our fixed costs and instead of dividing by the contribution margin per unit, we are going to divide by the contribution margin ratio, which is the dollar amount of contribution margin divided by the dollar amount of the sell price. The final calculation we can use is called the margin of safety. And the margin of safety is the amount by which the company's sales can drop before the company incurs a loss. The margin of safety may be expressed as a percentage of expected sales, or it could be done in dollars as well. If we want it in just straight dollars, we would take the dollar amount of sales that management expects and subtract out the dollar amount required to break even. If we want it in percentage, we would take the amount of that margin of safety and divide by the dollar amount of expected sales. This tells management how far off their selling expectations can be from their break-even point before they start to incur loss. And that's why we call it the margin of safety.